A mortgage is a loan that someone takes out in order to purchase a home. Typically, we would recommend that homeowners aim to have a down payment of 20% when they purchase the home. And the reason for that is because if you can put down 20%, meaning you have cash ready of 20% of the value of the home, you avoid something called PMI, private mortgage insurance. This is typically about 1% of the loan each year that you're going to have to pay in addition to the interest. So if you can avoid that, you can save several $1,000s. If you don't have 20% to put down, there's likely other options for loans for you as well. Once you have a mortgage, you're going to have to make a payment every single month. There are three main parts to every mortgage payment. The first part, the one that we like the best, is the portion going towards the principal. The principal just means the outstanding loan balance. So if you still owe $400,000 to the bank for your home, then every single payment makes a little tiny impact on that $400,000. The next thing, which is probably the biggest portion, at least for the first 10 years of your mortgage, is the interest. So the interest is based on that outstanding part of the loan, the outstanding balance. So if the interest is 6%, then every year you're going to pay 6% of the outstanding balance. Now, the interest amount goes down a little bit every single time you make a payment because part of that is going towards the principal and your balance is getting smaller. So the interest is calculated on a smaller balance each time you pay down some of the principal, which actually means if you can pay extra towards the principal each month, then you will end up paying much less in interest over the years, possibly tens of thousands of dollars. The third and final part of your mortgage payment is something called escrow. Escrow is really just money taken out of your payment and set aside in a separate account. And it's done all year long for you because there are two big expenses that are related to owning a home that has to be paid each year. One of those is home insurance. So you get to choose which company you get home insurance through, but they are going to send a bill that will go to you and will go to your mortgage company. And the mortgage company says, wait, don't worry. We have this money in the escrow account set aside for that insurance payment. So they'll make that payment each year. The other thing that the escrow account is sitting there for is for property taxes. Every single year, all of us have to pay property taxes for our home. It varies majorly based on which state you live in and whether or not you're close to a city or you're in a rural area, but it's going to be an estimate put into that mortgage payment and set aside in the escrow account. So every single month, the entire length of your mortgage, whether that be 30 years or maybe you chose a shorter term like 15 years, you will have basically the same exact mortgage payment amount. It could vary slightly if your insurance and taxes are changing. But even though you have the same payment every month for decades, a different amount will be going towards principal and interest each time, and the rest of it's going towards escrow. It's all based on how much you have paid down on that loan so far when it comes to principal and interest. Let me know in the comments what else you would like to know when it comes to purchasing your first home.